Hi everyone, Lyndon Crain here with the Super Mortgage team, local mortgage broker in Windsor-Essex. And today I'm going to talk to you about refinancing. How does it work? What are some things you need to consider? Let's jump into it. First off, what is a refinance? A refinance is when you access the equity in your home for investments, paying off high interest debt, accessing a lower mortgage rate, and much more. When you're refinancing your property, the maximum we can pull out in equity is up to 80% of your property value. So if your home is worth $1 million, we can pull out up to $800,000. And when we're pulling out equity, so up to $800,000 in this case, and there's a mortgage for $300,000 secured to the property, we would be paying out that mortgage of $300,000, and then you would have $500,000 that you can then use as you wish. You can use it for investments or putting it into the stock market. You can use it to pay off high interest debts like auto loans, lines of credit, high credit card bills, personal loans, and much more. You can also use the equity to renovate your home or fund your child's education. Most lenders do not have restrictions on where those funds are being used. Now, some lenders do. If the equity that you're pulling out is more than $250,000, some lenders will restrict where those funds are being sent. As an example, often some lenders will direct that the $250,000 or more equity is being directed towards an investment account. And they do this in most cases if they believe as a borrower you are high risk and they have concerns on where those funds are going. Most often, the individuals that we are helping in a refinance are accessing their equity to pay off debt and consolidate it into one easy monthly mortgage payment. And in some cases, we have literally saved our clients thousands of dollars per month when we look at the difference between all of their debts and the current mortgage they're paying and rolling it all into one and perhaps re-extending the amortization up to 30 years, 25 years if they're at a much lower amortization amount. And that frees up cash flow and drops their monthly payments. Then, when you're in a better spot and you have the ability to increase your payments, put money directly towards principal, double up your payments, that will speed up your amortization period. So in most cases, clients are accessing a 30-year amortization and then when they're ready, paying it off faster. Also, when you're refinancing, you may have the ability to add on a secured line of credit as long as it does not exceed 65% of your home's value. So in the event that you're pulling out equity, but you're not sure what you'll be using the funds for, some clients instead will use a line of credit because you only pay on what you borrow. So if you have a $100,000 line of credit, but there's a zero balance, you're not going to be paying on that money until you use it. Versus pulling out funds as cash, and let's say you're accessing a $300,000 mortgage on your home, and $100,000 of it is being sent to your bank account. That's the additional money that you're receiving because your mortgage is $200,000, so there's $100,000 worth of room. You will be paying on that additional $100,000 right away. So in those cases, if clients are not sure when or if or what they'll be using the funds for, they may just access a line of credit product that's secured to their home. And some lenders will actually increase that line of credit limit as you pay down your mortgage. Some other factors to be aware of when you're refinancing, typically legal fees are involved, as well as appraisal costs. Now, in most cases, your broker can roll in those costs as part of the refinance, so you do not have to pay out of pocket. If you are looking to access equity in your home, pay off debt, increase monthly cash flow, or any other opportunities that you see fit with equity that you have access to, I would love to help you get started. 226-787-4745.